Welcome to a new episode of Trader Babes. I am your host, Erica. This week we have seen a surge in volatility throughout the market. And with the short squeezes of earlier 2021, options trading has increased in popularity among beginner traders. For this episode, I sat down with seasoned trader and options specialist Dr. BullShark to discuss options trading, his own experience with the learning curve, and social media influence on trades. Of course, he also took the time to answer the questions you guys submitted to our Twitter prior to the show. Before we begin, don't forget to like and subscribe. So the first thing I wanted to talk to you about today is that you and I actually share something in common. So, and the first time I heard you do this, I cracked up. I was actually drinking something and I choked. So we both like to exclaim random obscenities to our trades. And I know that you like to do it with other members in the group. And I noticed that you always just have a really good positive energy. Is that something you like that helps you get into that mindset? Like, what is that all
100%.
about?
I mean, you
Yeah.
have to be positive when you trade. I mean, even if you're saying bad things at it, it's always with good intent, you know? I mean, at the end of the day, any trade you're taking it because you're confident about it. And if it doesn't go your way, initially, you're going to be upset, because you planned the trade, you're confident about it. And if it doesn't go your way, why wouldn't you be upset? But ultimately, it does end up going your way sooner or later, even though it initially didn't. So that brings the excitement factor when it comes back from the dead, so to say, right? So that's
Yeah.
that's where you see the emotions come into play. But the emotions aren't really controlling the trade. It's just me reacting to what's going on behind the scenes of the trade.
And just kind of keeping your energy level high.
Exactly. Yep.
And how did you make the transition into options trading? How long ago did you start?
So I've been trading options for like 2 years now. I used to trade primarily small caps, and small cap options, but yeah, most recently, about a year, I've been doing full-time large cap options trading. 'Cause that's where I found my biggest strengths and my comfort zone. So that's what I've been doing.
And when you are trading options, what is something that you want to avoid? Do you still trade small cap options?
I mean, I do trade small cap options, but they're more so swings rather than trades, because
Okay.
small caps are cool, and they will get hot again sooner or later. And what I mean by get hot, they haven't really been a thing for these past few months because I don't know if you remember last year there was a really big influx of volume of traders coming into the market. And after
hmm
COVID recovery started happening, people have been going back to their jobs. Less traders have been coming in every day and doing their thing. And, that takes money away from the smaller cap stocks, right? So it's really a transition of volume from those small caps to the large caps that I found my comfortability in, right? Because the volume, so to say, on the larger caps doesn't really shift as much as the small caps. So when I do find the small cap I like, I'd rather swing it for a week, month, or however long it may be. And if I'm already planning to swing that specific stock, why not capitalize my position harder by taking the option, and making more off of it?
So you use it to add to your position rather than hedge with the options, or do you do
Yeah,
that as
so
well?
I mean, you can do it both ways. Me specifically, I just use it to make more off the option or off that stock itself. Because ultimately, what an
hmm
option is you're kind of betting on 100 shares at once, right? So, for example,
hmm
let's say I like a stock that's $10. If I go take an $11 strike option, and in the next few weeks, that stock ends up going to $15, I can actually execute that option and buy 100 shares of that stock for $11, although the underlying price is trading at $15. So you're technically getting the shares for cheaper, right? And
hmm
it doesn't necessarily mean you have to execute the contract itself, but you could even just resell it and take money off the premium and make the difference.
Will you ever do that by like selling a cash secured put to get the shares, or do you just buy calls straight out?
No, I'll never sell cash secured calls or puts. I just buy the shares straight up if I need to. But
Okay.
most of the time, I'm just
And
flipping the premium.
got you. And when you started learning options, because at least for me, I had a huge learning curve, still have a huge learning curve. Did you ever have like an aha moment where things finally started clicking for you?
Yeah, I did. So one of the biggest things that traders make a mistake with is when they take a trade, the first thing they're thinking about is how much can I make off this play? That's like the
Hmm.
biggest no-no for options trading. You can't ever consider how much can I make off this trade. In reality, you have to really calculate the risk reward per trade. So how much can I lose off this specific trade for how much I'm putting in? Right? So before I would kind of tunnel vision saying, oh, I can make this much off this option, I can make this much off this option. And what that would drive me to do is buying options that were way out of the money because A, the premium would be cheaper and it's more enticing for traders with smaller accounts to go in and take those options, right? But when I had my aha moment was when I actually realized the fundamentals of options trading, where if you take an in the money option, the option itself is going to move almost exactly like the underlying stock, right? That way, you're kind of following the stock underlying and your option is moving with it. Whereas an out of the money option doesn't really move with the underlying. So let's say, for
Hmm.
example, a call. The stock underlying would have to move up a lot more for you to become profitable on that option than it were if you were to take an in the money option. Even though the premium for the in the money costs more, you're more likely to profit on it than an out the money option.
Hmm. And that has a lot to do with like measuring the delta, right? With how much the contract premium moves with the stock.
Well, yeah, exactly. So delta is ultimately what's going to happen to your option premium per dollar move up. So, for example, let's say you buy an option with a premium of 50 cents, right? And it has a delta of zero point 0.5. That means for every dollar the stock moves up, you're going to get paid 50 cents on your premium. So, let's say it does move a dollar up, you've made 100% on that contract because you're adding 50 cents to the 50 cents that you put to buy the option, thus 100% increase in your position.
So it's less risky, at least as far
Exactly.
as options go, to
Trading in the
stay.
money is 100% less risky than trading an out the money option.
Okay. And would you say that that's probably the biggest detriment to those who are looking to learn options or maybe just starting as they're trying to go for the cheapest contracts that they can because they think they'll see the
That's
most
actually
profit
the
gain or they don't want
exact
to spend
way.
it?
Yep, that's how most beginning option traders blow up their accounts, right? They they kind of pick the strike that's gonna most likely correlate with their account size, which is completely wrong. They shouldn't be doing that because it's just gonna increase the likelihood of them blowing up their accounts, right? So for example, I don't know if you've ever seen like a Tesla premium or a Moderna premium. They're super expensive, right? They cost
Yeah.
almost anywhere from like $400 to $700 per contract. And when someone
Hmm.
wants to go trade Tesla, they don't really want to pay that $700 premium. So what they do is they'll go buy something that's way out the money, something that costs under $1. But then Tesla's moving up and their contract's not. Why does that happen? That's because of that thing that I just explained with the delta, how for an out the
Hmm.
money contract, they're not going to make that big of a move unless the underlying significantly shifts in their favor, right? Whereas an in the money
Hmm.
call with a more expensive premium will make money more easily than taking those out the money contracts.
So it's probably better than if you can't really afford to buy or to trade an actual decent strike, then it's probably better just to leave Tesla alone and
That's
trade
exactly right.
something cheaper like Neo or something like that.
Exactly. I mean, one of my favorite things personally to trade is QQQ and SPY. Why is that? Number one, So their options premiums are generally super cheap, right? They stay under $1, especially for the contracts that expire within 3 days. And
Mm-hmm.
they're very fluid. They have a lot of volume, a lot of open interest, meaning if you do take a lot of contracts, you'll be able to unload them and not be stuck with those contracts. Whereas another stock that doesn't have a lot of open interest or volume per contract, and you take a lot of those contracts, you won't be able to sell them even if the premium moves in your favor.
Mm-hmm. And that's happened to me before on a swing when I was first starting to learn. I took option. It was so silly. Like the options with it was on a penny stock and it had a huge spread. And then I just couldn't get rid of them because there were absolutely no buyers. So
That's
yeah,
exactly
that's
right. You get stuck bag holding.
yeah.
Even if your contract
Mm-hmm.
move up on you, you won't be able to sell them.
Yep. And then you're just screwed. You can't exercise or anything because they're out of the money.
Exactly. And another thing that you mentioned is, spread. If you're playing QQQ and SPY or any of the indexes, IWM, VIX, they're all going to have generally tight spreads, anywhere from like 2 to 3 cents maximum. Whereas let's say you go pick a stock like Novavax, go look at the spread. It's going to be around like, I don't know, 80 cents, dollar spread. You don't want to be trading those because even if they do move in your favor, sometimes either the spread can widen or tighten up, and you're not really in control at that point. Yeah, you'll make money, but it's going to be more difficult. Why do that as a beginner options trader when you can go trade, just the QQQ or just the SPY, for example, get good, learn the personality of how that index moves on a daily basis, and capitalize every day on that one stock. So that's how I would say you would get better at options trading.
And that was actually going to be my next question for you is for beginner traders, if there was a singular strategy or a singular focus that you would recommend them, putting their concentration into. And so you would recommend doing something like index options trading
Yeah,
first.
so I mean, it doesn't necessarily have to be index. I would say, pick a
Mm-hmm.
handful of stocks, anywhere from 5 to 10 stocks. Set alerts on each stocks at key levels. That way you're not looking at all of them throughout the day. And just wait for your alert. When your alert comes, you're gonna know, at this point I can go long, or at this point I can go short. Because I don't know, anyone generally trading knows more or less how to draw, support and resistance levels or like key zones, right? So that's how you
Mm-hmm.
kind of capitalize on options using key zones. You know, for me specifically, I love three stocks. I like Disney, I like QQQ, and I like AFRM. The reason I like them so
Mm-hmm.
much is because I trade them almost every single day. Even without looking at the stock, I'll know what it wants to do that day because of the fact that I've traded them almost every single day for a year, right? So that comes back to stock personality. Small caps don't necessarily have that much personality in the sense that they can influx super easily with volume coming in, or if they have social media influence, or if something in that nature happens. Whereas large caps, no matter how big the social media influence, they're not necessarily going to shift that much. It's more
Mm-hmm.
stuck on technicals and fundamentals and news, etc. So trading those type of large cap stocks every day, will make you a more consistent options trader in general.
Absolutely, because it's their moves are easier to predict and you're able to just continuously replicate what you're doing for
Exactly.
the most part.
I mean, you
Nothing's
know what the
guaranteed, of
QQQ
course.
is, right?
Of course.
So, I mean, in general, like SPY and QQQ are built to go up, right? It's for people
Mm-hmm.
to put their money in, invest passively, and over time grow their accounts, right? So
Mm-hmm.
by nature this stock is built to go up. So why not wait for key levels, and when it's ready to make its move, capitalize on it. You don't need to know or try to predict where this thing is going. You just have to wait for the right moment, be patient, and be determined to catch that move, not try to predict when it's going to happen.
Yeah, and I feel like a lot of people put a lot of concentration into trying to figure out what spy or the Qs are going to do next and panicking whenever there's any kind of little drop. And, is this the apocalypse or anything Something like that. I mean, no matter what size the pullback, you bring up a really good point. The stock market is designed to continuously go up through the major indexes. So that's a really good, helpful tip is to, you want to buy something that's constantly appreciating and it's easier
Exactly.
to build a strategy from.
Hmm.
And talking about your strategies, when you're doing something like a day trade versus swinging option stock, what are the biggest changes in your strategy or what you look for?
So there's money to be made at any time on any stock, It just depends on what that certain stock is. For example, QQQ or SPY, there are multiple opportunities within the day to make money off of it, right? Look for specific trends, downtrend and uptrend, and wait for there to be a break of that trend and play the opposite side. For example, if QQQ is on a downtrend, it's down like, 1.8% on the day, you know that more or less by personality, this thing doesn't want to go down more than 2% on a day. If it does, that's kind of catastrophic, right? 2.5% is a big deal going down on QQQ in one day. So,
Mm-hmm.
I generally don't like playing the first 30 minutes to an hour for the market after the market opens, right? Why? The sentiment on the day hasn't really been decided at that point. I wait for it to kind of do its thing, choose the sentiment, whether it's up or down, doesn't matter to me. I just need to know on that day how QQQ feels or how SPY feels, and then I can play the opposite side of it, right? So there's going to be trend days in the market, there's going to be sideways days, there's going to be choppy days. Why not wait for the days that it's a trend day where this thing is going to ride up? You wake up, you see it, you're like, oh, this thing is bullish. And you can just ride that thing all the way up all day. It was just, I don't know, 2 days ago. I don't know if you were in the GMT chat, but I called a 280% move on the QQQ with 0 days till expiration contract. How was I able to catch that? QQQ was down 1.8% on the day where the sentiment was super bullish. There was around 4,000 inclining stocks, less than 2,000 declining stocks. So that's a pretty bullish day. Why would
Mm-hmm.
QQQ by nature be down that much? It shouldn't be. And that is kind of what triggers me to think, okay, this thing is going to recover to some degree. I wouldn't say it's going to go green, but it's probably not
Mm-hmm.
going to end the day at minus 1.8%. Maybe it's going to end the day at minus 1%. And that move from minus 1.8 to minus 1% will give you over 100% move on a 0 days till expiration contract, right?
But
So it's
those
it's a
are a lot
sentiment thing.
riskier.
Oh, they're
Yeah.
definitely riskier. I mean, at the end of the day, like, you choose your risk level, right? So you can
Mm-hmm.
pick whatever expiration you want. On that same move, you could have gone and taken an expiration that's going to go, a week out, 2 weeks out. Obviously, you're going to get paid less, but you're going to minimize your downside. But for me
Mm-hmm.
specifically, I just know that this move is going to happen. So why not capitalize the most I can off that smaller move by playing the 0 days till expiry option, and make that bigger percentage for that smaller move, right?
Yeah,
But again,
I
I don't
agree with
recommend that.
you.
Yeah, I don't recommend that for beginner options traders because you
Right, the level of confidence.
it's definitely takes a level of confidence to understand that that move is going to happen at that moment, right? Or seeing the trend breaking, or seeing that reversal taking place, right? So that's where conviction comes into place. When you trade that stock every day for a year, every day for 2 years, it's going to make that move. Whereas someone just coming in and testing the waters shouldn't be going and playing those 0 DT options. Or if they are playing it, play it with one contract and see how it's going to react to the underlying move and get a feel for it before you go and put like 10-20% of your account in that one position, because that's how you blow up.
Yeah, definitely. And just to clarify for those who maybe aren't familiar with how to measure sentiment in the markets, you're referring to like an options flow, right? To see what the put call ratio is to see if the sentiment is more bullish or bearish for the day?
Um, I mean, you can do that. The thing is with the SPY and the QQQ, that won't really matter. But on smaller cap
Okay.
stocks, mid cap stocks, it definitely matters, right? But the thing is, that sentiment can shift so quickly, it's ridiculous, right? It's all a
Mm-hmm.
matter of fear and greed. For example, uh, like there's been daily reverse repos been going on where in the beginning of the day you'll see a giant flush in the market, and then you'll see the Fed announce that, hey, we did $1 billion daily reverse repo. They close it out, and then the rest of the day the market rips, right? So within a half an
Mm-hmm.
hour long time period, the entire sentiment of the day changes. If you go look at that call to put ratio, it'll change. So for me on
Right.
the indexes, it doesn't necessarily matter. But if you're playing individual stocks where it's not a culmination of a bunch of stocks, for example, AFRM, Disney, uh, I don't know, Lucid Motors, for example, had a super bullish flow. The flow will matter because it'll give you sentiment
Mm-hmm.
saying, hey, everyone else thinks it's going to go up. It's probably going to go up.
Yeah. And so what do you use then to kind of measure the sentiment for the indexes then?
So, for example, the best thing I look at is when I wake up is on the day. How many stocks are on an incline and how many stocks are on a decline, right? That way you'll have a general idea. Oh, bunch of stocks are dropping today. We're probably in a bearish sentiment. Or, oh, look at
Mm-hmm.
that. Maybe 75% of all stocks are on an incline today. That's a quite a bullish sentiment for the day, right? And that'll kind of help you determine, okay, of those stocks that are on the incline, what percent weight do they hold in the SPY or QQQ, right? For example,
Mm-hmm.
Apple, Tesla, Microsoft, they're very heavily weighted on those indexes, right? So if you know those things are green on a day, they're going to help push your SPY and QQQ up, right? And also inverse, if you have QQQ and SPY ripping, they're going to help your Apple, Microsoft, or whatever Tesla play give it that extra push, right? So there's always a correlation between those indexes and heavily weighted stocks within those indexes. So when I trade personally, I have those indexes up at all times while I trade whatever stock I'm trading.
And that's a really good point because I feel like a lot of times people don't take into account how much of a correlation there is with the indexes. So
Oh,
I
100%.
keep mine up as well.
Yeah, I
And
generally keep
for
Yes, sorry to bother you. I generally keep
no,
those
you're fine.
indexes up, on a 5 minute
Mm-hmm.
time frame, a 10-minute time frame. And something I've been doing recently is keeping the inverse charts up just to see, because you're going to have a bullish sentiment always, right? So
Mm-hmm.
by flipping the charts, you're going to be able to see, hey, maybe I can go long with puts, you know, and play that
Mm-hmm.
as a bullish sentiment on the inverse side. And maybe you see a pattern that you didn't see, like for calls. Maybe you'll see them on the puts. So I try to keep three of those charts for QQQ and SPY up at all times.
Did it take you a long time to get used to using the inverse charts? Because I tried that and I couldn't.
I
It
mean,
just it
not
bothered my
necessarily.
brain so much.
So
Really?
yeah, Rodessa actually brought that up to me maybe, I don't know, a month ago. And since then, I would
Mm-hmm.
say I've become a better index trader within that 2 weeks than I have in the past year of trading indexes. Yeah, I was already decent at trading them, but as soon as I started using the inverse chart, I was able to kind of track micro trends within the day more easily. Yeah, I'm not talking about it for the general big picture idea, but within that
Mm-hmm.
moment, what's going to happen to the SPY and QQQ?
Okay, so more for the intraday strategies.
Exactly.
Okay. And when we're talking about swinging options,
Okay.
is there a worse time to buy? Like if you're trying to buy monthly, is there a worse time to place your order for those?
Yeah, so that's a good question. So what most people don't realize is risk reward for expiry. So I can go over that a little bit. So
Mm-hmm.
you have to realize the biggest risk out of any option is an option that's out the money that expires the soonest, right? A little less risky is an option that expires soon, right? But it's in the money. A
Mm-hmm.
lower risk version of those is taking something that's further expiry and in the money, and or out the money, excuse me, and the lowest risk is taking the furthest expiry in the money, right? Again, you'll make the least taking the last strategy where you're taking something that expires far away in the money. You'll make the least, but you're going to be risking the least, right? So there's also another factor to consider when you're swinging these options, something that a lot of people don't really pay attention to, but it's kind of super important. And that concept is implied volatility, right? And this comes
Mm-hmm.
into play big time for small cap option swinging, right? So let's say you see an option or a stock, for example, um, I don't know, any stock, it doesn't matter. Let's say you're trying to buy that option to swing while that stock is ripping, okay? Chances are the implied volatility of that stock is going to be super high, over 200%,
Mm-hmm.
over 150%. That's quite a high implied volatility. And what happens is, let's say you buy that contract and the implied volatility drops, regardless of if the option, or regardless of if the underlying itself moved up, your option premium will drop because the implied volatility dropped. So the best time to buy a swing is when the option itself has a low implied volatility. Because guess what? The opposite can happen. If you're buying at a time of low implied volatility and then the implied volatility spikes on you, guess what? Your option premium will also spike on you, even if there's a small move in the underlying stock.
So the best time probably to find the lower implied volatility is in times of consolidation for the
Exactly.
stock.
Yeah,
Okay.
super low
So when
implied
you're doing a
volatility.
swing, okay. So when you're doing a swing, you want to buy more in that consolidation zone when your IV is low to prevent the IV crush that we hear
Exactly.
about.
That's how you avoid the IV crush. So the
And
furthest
for day
strike,
trades, go ahead.
the furthest strike you want to go is probably one or two max out the money with super low implied volatility, so you can still capitalize, nicely on that move and not risk as much as you would risk if you're buying at a high IV time.
Right. And for day trades, do you still try to put in your orders during times of consolidation, or do you ever worry about the time decay burn?
Um, I mean, that depends on the contract, right? So if you're buying something that's 0 days till expiry, then the time decay burn is going to be a factor that you have to consider, right? But let's
Hmm.
say it's a Monday and you're taking an option that expires Friday, that time decay is not going to affect your contract like whatsoever, because that theta or time decay won't really take any type of effect on your contract until the next morning if you swung that contract, right? Then you will be chunked on the theta, right? But intraday, while you're holding that contract, it's going to be almost an infinitesimal effect on your option contract.
And another topic that you talked about a little bit ago that I wanted to expand on is kind of getting away from options a little bit, but since we were talking about small caps, something that's been a recurring theme for us is the influence of social media on a stock's price. So, and I would love to make people a little bit more aware of that because it seems like with small caps, any you know guy named Bob with a few thousand followers on Twitter can make this stock move.
Whoa, whoa,
So,
whoa!
what
We
are your
love
thoughts
Bob.
on it? Love Bob, Tim, Fred, whoever.
No, so that's actually a good point. I would say, I don't know, within this last year, social media has been a big, big, big influence on just stock trading in general and how a stock will move, right? So this will again take it into bigger consideration smaller cap stocks versus larger cap stocks, because an influx of volume will affect something with a small float more than it will with the stock that has a big float, right? So, we had some awesome people come into play this past year. For example, Zach Morris, anyone, but just specifically speaking about Zach Morris, I think anything they do isn't a bad thing, right? I don't consider them pumpers. I don't consider them, you know, influencers, but they definitely help bring attention into a stock, right? So, for example,
Mm-hmm.
most recently, there was Dat Chat. So, I actually bought Dat Chat the day of its IPO, not because of anything anyone posted, but because I downloaded the stock. I like the stock. I think that it has a very useful function, right? So, I bought it on its IPO day, saying, hey, maybe this is going to be like Snapchat. Snapchat, in my opinion, isn't the greatest stock. They make most of their money off ad revenue, etc., but their functionality isn't as good because, by nature, that Snapchat isn't an encrypted messaging system, whereas that chat is encrypted, right? So, it's wild to say that people want to send messages without anyone knowing what they're sending, like,
Mm-hmm.
so they don't want to be meddled with.
Something like Signal, where it's
Exactly.
secure.
hmm So that chat is a way to do that, but have it be encrypted and with group messaging. So I like the stock fundamentally. Next thing you know, you have someone like Zach Morris who can talk about that stock and not just bring attention to it to a couple people. Maybe my outreach isn't big if I talk to them about my idea, but someone like Zach who has 500,000 plus followers can reach a large group of people and just share his thought process about the stock. That doesn't necessarily mean he's
Mm-hmm.
pumping the stock. He's just bringing attention to this stocks or this idea, this capability, what this stock can do, right? At the end of the day, it's
Mm-hmm.
his opinion. This thing can go to zero, and no one to blame but the person that bought the stock itself. People shouldn't be blaming him
Right.
or anyone, right? He's just sharing his fundamental analysis, his opinion. So, social media will have a big effect by bringing volume into places that people might not be looking. Dat chat, CEI, whatever it may be. CEI, as you've seen, has an insane amount of volume consistently for the past 3 weeks, right? And a big factor of that is social media. So, yeah,
Mm-hmm.
it has been influencing the stock market in ways that no one could have ever predicted. It's wild.
Yeah, and then you also have the other side. You have all the followers rushing to buy in, and then you have the other side, which probably has very deep pockets, which can come in and short the stock like
That's
that.
exactly right.
To try and trap that, like they see it as, not sustainable volume,
Yeah,
and that's another
so
risk.
that's actually funny.
Hmm.
Last year those shorts or those market makers with a large amount of money were trying to come in and short a stock, but they weren't as successful. But now, as I was saying,
Hmm.
that volume of people that were trading last year just isn't there. So they're more easily able to target a stock that gets talked about a few times and then kind of disappears into social media space, right? But the ones
Hmm.
that keep being talked about, for example, Dat Chat and CEI, can continue doing its thing, and shorts are gonna have trouble taking that thing down.
That's true, because once it's trending,
It's
it's
trending.
gonna
It's
just
gone.
kind of keep making the rounds.
Exactly. Like, go look at CEI. Go look at Dat Chat. That thing hasn't even dipped. Hasn't even had one red day in the past, like, I don't know how long. Why? Because
But
it's
doesn't that
it's
make you a little bit
trending.
skeptical about it too? Like at some point, it's gonna have to come back down. It can only go green for so many days.
I mean, what makes you say that? I mean, look at
Well,
look at the
because
SPY. That thing's been ripping nonstop for the past 30 years.
no, I agree with that. I just mean, as far as, everything that's going up, it has to have at least somewhat of a pullback in order to bring in more volume, at least from what we see usually with institutional buyers. So it has to have just a little bit of pullback. And I feel like, you know, if you're
The
not smart about
sustainability.
it and just continue, yeah, if you just keep buying it and keep buying it and you're just it's the top, but you think it's going to just keep going up, at some point it is going to have a pullback, and we don't know if how much panic is going to be there because of the social media
Exactly.
influence.
So that's a good point that you bring up. But again, ultimately it matters when you took your position. So for
Hmm.
example, for CEI, from what I remember, Zach Morris called that thing under 50 cents. So everyone had an opportunity to really get into that stock under $1. So at this point, they should be scaling out. If you're not taking profits when it's in front of your face, that thing is over 500% profits from the point that he called it till now, right? So
Mm-hmm.
at the end of the day, it comes down to the person trading the stock, what your conviction is on that stock, and how far you can see it going, right? So fundamentally, it should have pullbacks, but you should be scaling out before those pullbacks even happen, in my
Right.
opinion.
Not buying in
Not
at the
buying
top.
in while it's ripping, exactly. And
Yeah.
on the contrary, selling into that rip.
Mm-hmm. And do you feel like fundamentals still have the same weight as they always did within trading, or do you feel like things have been skewed a little bit?
No, they're definitely skewed. I mean, again, for large caps, less so than small caps. But yeah, there's
Mm-hmm.
definitely a big, big influence in social media usage, Discord, Twitter, whatever it is, Instagram, on the fundamentals of stock trading. Because in reality, you do have a lot of people with zero to very little experience coming in trading stocks, expecting the gold rush, and then losing all
Mm-hmm.
their money and disappearing back into their day jobs, right? So you really want some type of system to be sustainable, to be in it for the long term, right? And
Yeah,
for me
because this isn't how the
specifically,
stock market always is,
yeah,
right?
exactly. So, for me, I found that consistency in large caps and how to make profit off large caps without having, a huge amount of cash. Like for the small guy, go play the options.
Mm-hmm.
If an underlying stock costs $150 and it moves up $5, right? And you bought one share, you've only made $5. But what happens if you have an option and an underlying of the stock moves from 150 to 155? Let me tell you something. You've made a huge amount of profit.
Mm-hmm.
So that's
I
where I've
agree
kind
with
of
you.
found
That's
my
why I'm
consistency.
yeah, that's me too. I'm completely like I can't switch back from options now. Now that I've started to get a hang of it. So
Exactly. No, I
and
mean, don't get me wrong. Like, small caps are still fantastic. It's all about what you're
yeah.
comfortable with? Like, I don't
Mm-hmm.
recommend someone going and trading options without some type of fundamental knowledge of how stocks move in general, right?
Yeah,
Without
it's
having
definitely
that
not how you want
knowledge
to
of fear and
start.
greed. Exactly.
Yeah. And when I know that you've taken a lot of time to talk to me tonight, so I am going to give you our last topic, which is our user submitted questions.
Cool.
These are from Discord and Twitter, but we got quite a bit of feedback. So I just wanted to ask you some of their questions if you don't mind, and then I will
Cool.
let you go.
All good.
Okay.
Let's hear them.
The the first one is when making an entry and exit, do you wait for the candle to close?
Oh, all the
I'm
time.
assuming that's on a day trade.
Yeah,
Okay.
so I'm a big fan of trading the 10-minute chart. I mean, you can trade whatever chart makes you feel comfortable. I know a lot of people trade the 5-minute as well. I also like trading the 5-minute, but ultimately, to find a real move on an underlying stock, you want to trade the 10-minute candle. And to not get, shaken out on your position, you want to let that candle close, right? So if you do take your position and this thing starts wicking down on you, instead of shaking out and selling your position on for a loss, generally what I do is I like to scale into my position. So for example, let's say I was gonna put, I don't know, $1,000 on the stock, right? And on my initial position, I'm not gonna put $1,000. I'll put 250. And if that thing wicks down on me, then I can start scaling into my position. So ultimately, I know my biggest risk or my biggest position size is still going to be $1,000. But if this thing takes off on me before I get my full position, cool. I'll be in that position with 250, $300. That way my risk is still small and I'll still capitalize on the move, but I'll still have money if that thing drops on me and I'll be able to average down, buy more, and capitalize even harder on that comeback.
So you have very high convictions in your
Exactly.
trade so that you're
Hmm.
not scared out by quick
No, no. And that's why you
dips.
let the candle close every time.
And for newbies, what is the max loss percent where you would suggest that it is better to get out and move on? I'm not sure if that's per trade or of your
I
account.
I think I understood what they're asking. So, a
Okay.
lot of people will have like a max pain of like, I don't know, 15 to 20%. But I think that that's very general term, and you shouldn't really let like the contract percent amount determine whether you're going to close out or, open that trade. So what I mean by that is like, you know, if the contract itself drops 15% on you, and the stock underlying is still within that movement that you're looking for, why close it for a loss when you know that the underlying stock still hasn't done its thing? And that's where patience
Hmm.
comes into place, where, don't trade your P&L on the option, but trade the actual underlying. That's why I like trading the in the money contracts, because they're going to move most similarly to the underlying stock, whereas the out the monies, it's not. It'll pay you more,
Hmm.
but it's not going to move like the underlying in no means.
Yeah. And then once, even if your underlying does start to move in the right direction, if you've picked that wrong strike, if your IV has tanked or your theta is too high, then it's harder for that to recover. So it's so important to pick a good strike.
Exactly.
For newer traders who are consistently losing, what is the one piece of advice you would give?
Stop taking a lot of trades. You got to be patient. You got to wait for the trades that actually matter, and you got to build your conviction on those trades. So the best piece of advice is building a system that's repeatable. And I kind of learned that from Ripster back in the day. Instead of trying out trading like a million systems, pick one or two systems that you really like and practice them over and over and over again. And go look back at previous charts, like go look at, I don't know, the past 100 days on the QQQ, and go test out your system and see if it works within that time frame. And if it works, try to repeat it. And if you have a system that's not working out for you, change it. Why are you going to keep repeating a system that's flawed? So you got to back test and make sure that your system is actually a profitable system for you to keep using it over and over again.
My last two questions are from Discord from your friend, White Goodman.
Okay.
He would like to know first, how many pairs of pants do you go through per day on average?
At least 5 pairs.
And then lastly, he is hoping that you would tell us about your accent and how you pronounce the word white.
Oh, so I'm actually Armenian Lebanese. So sometimes it'll like my accent will slip out really, really heavily, but I'm getting used to it. But yeah, multiple times I've called him Wyatt, and he gets super angry when I call him Wyatt. Wyatt Goodman.
That's amazing. That's amazing to know. Yeah, he had submitted those little gems for you.
Oh yeah. Um,
Thank you so much for coming and
yeah.
talking to me today.
Thanks for
I
having me.
love listening to you in the room. You crack me up, and honestly, I love the advice that you gave for newer traders. I think that it's something to really actually listen to.
I really appreciate that. Yeah, just some closing remarks. Big shout out to, everyone that I've been able to help out, even to the smallest amount. If I'm just here to help everyone make money, I can sit here, do this on my own all day long, but if I know I'm helping someone, that's all that matters to me. So shout out Real Ones, shout out GMT, shout out everyone that's been there on this trading journey. It's been incredible, and we're just getting started. So let's kill it.
One last thing I wanted to mention to you. You and I were the ones who popped Rodessa's options trading cherry.
Yes.
You and I both. I kept pestering him about Apple, and I think he finally traded Apple. So he's doing awesome.
Yeah, Rod is the one of the people that I've mentored, within this past month, and the growth from that guy is just incredible. He's a very very talented trader in general. And yeah, I mean, everyone has the capability to do that. You know, it's just the amount of work and the determination you're willing to put in to get there, right?
Yeah, definitely. Want more Trader Babes? Subscribe now and connect with us on social media for exclusive content and access you won't find anywhere else. And we'll see you right here on the next unforgettable episode of Trader Babes.